titans of industry gambled with your life savings, insulated from the fallout. This isn't just history, it's a terrifying blueprint for disaster, echoing in headlines today. We'll expose how a seemingly unstoppable economic boom became a carefully engineered bust. Wall Street didn't just witness the erasure of generational wealth, it helped orchestrate it. The answers lie in audacious market manipulation and ruthless greed. To understand the betrayal, we enter the intoxicating 1920s, a time when America seemed to invent the future. Mass production made consumer goods, cars, radios, affordable. Wages rose, fueling national aspiration. Everyone wanted a piece of the American dream. That dream became tied to the stock market. Brokers promised quick fortunes, urging clerks, teachers, and housewives to invest. The New York Stock Exchange was no longer just for professionals. It was a national spectacle, a supposed road to instant riches. But the foundation was shaky. The boom was built on cheap, plentiful credit. People weren't just investing savings. They were borrowing heavily to buy stocks, buying on margin. Put down 10%, borrow the rest. It looked foolproof as long as prices only went up. The powerful bankers and brokers weren't blind to the risks. Some were actively creating and exploiting them. They understood crowd psychology, the allure of easy money, and the inevitable panic. They were laying the groundwork for a financial earthquake. The market's ascent became pure speculation. It was a casino where the house had loaded dice. The core betrayal was the rampant use of pools. These were secret groups of wealthy investors who colluded to manipulate specific stock prices. Here's the trick. Pool members quietly bought up shares. Then they spread rumors and engaged in wash sales, buying and selling to themselves to create the illusion of high demand. Ordinary investors, fearing they'd miss out, would rush in. Once the public drove the price sky high, the pool members would dump their shares, cashing in huge profits. The stock would collapse, leaving the public holding worthless paper. This wasn't a glitch. It was a deliberate legal form of theft. Adding to the danger were complex, opaque investment trusts. These pyramids of companies amplified risk. A small drop at the base could trigger a catastrophic collapse throughout the entire structure, multiplying losses exponentially. The insiders, the bankers, brokers, and elites, took fat fees and commissions, insulated from the risks they promoted. They engineered a symphony of speculation, knowing the majority would pay the ultimate price. The illusion was about to shatter. The breaking point, Black Tuesday and its aftermath. The market fever couldn't last. The underlying economy was stalling.